Hit it.
It's Friday, March 8th, 2024, episode 234. I'm Patrick Ceresna.
And I'm Kevin Muir. This week, we welcome David Cervantes, macro strategist and publisher of the Pinebrook Capital letter. We have a fascinating discussion where we learn David's unique way of thinking about the economy and markets. Then Patrick checks in on what the squiggles are telling him in talking charts.
And then we end with crayons with Kevin. Folks, we might even drink some beers along the way. So Danny, hop on. What beer am I drinking today?
You are drinking this hazy, fruity, intensively malty, triple hopped. Oh, my screen's just died. No way. I can't even read it. Wait, hold on. Intensively malty, triple hopped wheat pale ale with its balanced notes of citrus and exotic fruits. Oof. Lent by the particular types of hops, Citra and Hollanteur Blanc, is worth all the risk to the farmer.
All right. Well, this is the steam brew.
You probably should have mentioned that bit, right?
Yeah, it's the wheat pale ale, and it's fantastic.
Patrick, I got to say, you sound like shit, buddy. You figure a beer will help?
You know what? I'm taking one for the team here. Like, you know what? Someone's got to drink the beer on the show, so I'm doing it. But this is fantastic. I love I love their little motto. It goes, "Let's oil the gears of life."
There you go.
Anyway, Kev, give us some fucking side effects.
Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in the show. Side effects of too much huddle may include the inflatobabble syndrome. Affected individuals experience a temporary but significant increase in the production of hot air, leading to uncontrollable urge to spout exaggerated stories and make grandiose claims.
That sounds actually
Check
something
in
like
on Macro Voices if you want. You're suffering from that. Yield curve yawning. A rare but highly contagious condition that causes excessive yawning at the mention of the term yield curve inversion. Oh, that's awesome.
Yeah.
I love that. And finally, policy palpitations. This condition causes an individual's heart rate to synchronize with the pace of financial news tickers when FOMC announcements are imminent.
Oh, I love it. I love it. Okay.
Well done.
Let's get to the guest.
It's our great pleasure to welcome to the show David Cervantes, the macro strategist and publisher of the Pinebrook Capital letter. David, thanks for joining us.
Hey, happy to be here. Thanks for having me.
I've looked forward for this for a long time. I was kind of reviewing some of your other interviews and your tweets and stuff, and I think that there's going to be a lot that we agree on. But before we start talking the markets, let's learn a little bit more about yourself. Where did you grow up?
So originally from California, went to college at UC Santa Barbara, right on the beach. So
I was actually looking this up as I was researching you a little, and I didn't realize that it is literally on the beach. So do you guys like surf? Like did you grow up surfing first of all?
So I did not grow up surfing, but I did take up boogie boarding and body surfing there.
Okay,
but it was not uncommon to see people showing up in a wetsuit and a surfboard carrying a surfboard into class. They would leave the beach, catch a lecture, and after the lecture, head back to the beach and catch the waves. So that was not common.
That is an awesome story. That is great.
I mean, it was literally, my dorm was, I had a beach view, and my college apartment similarly was on a cliff overlooking the ocean. And when I left, I just knew I would never have that for a long time, if ever. And so far, it hasn't happened yet. I haven't had that beachfront view I had in college.
Now, did you grow up in LA? Like you say you're from California. Was this?
I grew up in a small town, farm town outside of Fresno.
Okay.
It was one of those things where, small town, once you leave, sometimes you don't go back. So I haven't been back, and that's that.
Oh, that's awesome. Okay, so you're there. Are you studying economics at that time?
So at that point, I did a double major in economics and international relations. I did a study abroad in Paris. After my time was up in Paris, I stayed there. I didn't want to come back.
Okay.
Got a job at the Hard Rock Cafe selling T-shirts because I'm a native Spanish speaker.
Right.
And, being there, I picked up French. So I was able to, hawk some Hard Rock Cafe T-shirts to American tourists, Latin American tourists, Spanish, you name it. So
as a Canadian that struggled with my French my whole life, you just picked it up like after working, a couple of weeks at the Hard Rock Cafe?
I took 2 years of college level French.
You did? Okay.
And then, I went to school in France, and then I get this job, and by then I was pretty fluent by the time I got the job, and
okay,
I was also younger. You're younger and smarter. You can pick things up faster. So now,
right?
Good luck to me, but back then it was pretty quick.
So now, did you just stay there just because you wanted to experience Paris, and did you eventually get a finance job there, or did you have to come back to school, here and back in the U.S.?
My work permit ran out, so I had to come back to the U.S. At the time, I had a brother that lived there who's still there. He's an economist at the OECD. He's alive.
Okay.
He's been there 35 years. So, I crashed with him for a little while, and over the years, I'd make frequent trips. Now with family and kids, a little harder. But we were there 2 years ago to visit him. So I've always just through my own personal experience and with him being there, have maintained a kind of an affinity for going back and spending as much time there as I can.
Okay. So you came back to the States, and did you get a job in finance, or did eventually I see you got an MBA? Was there some work before that?
Yeah, there was a lot of work before then. First job out of college was with Wells Fargo. I got recruited to be in their credit training program, corporate credit underwriting. So things like loan syndication, revolvers, lines of credit. Lines of credit. We were dealing with the middle market. So I was in. The location was the San Jose office. So that means all these up and coming, tech startups back in the mid '90s. I remember the most famous one was. I was assigned to underwrite a revolver for some company that wanted to auction off things on the internet. And I'm like, what the hell is this? And it turns out it's eBay. So I was smack in the middle of that. But ultimately, I wanted to be in a more markets-based environment. So
right.
Incidentally, I went to Paris on vacation to visit my brother. I stopped by New York City, saw a friend that I studied with in Paris, and it's kind of like I gotta move to New York. So I basically went back from my vacation, quit my job, and bought a one-way ticket to New York. And luckily, it was 1998, so everyone's hit the .com stuff, and the banks were short of people. I had some, vis-a-vis the credit training. I had some fixed income type exposure. I had a pulse. I spoke Spanish, and I landed on the emerging market fixed income trading desk at JP Morgan. So, within a month. So it was just one of these things where I literally showed up without a job and one suitcase, and a month later I have a job, and a month after that I have an apartment. So it was the time where things were just happening. It was fun. It was really cool.
Now, what were you? Was it FX? Was it bonds? Was it equities? Or was it everything? You were just covering the region.
So started first with the Brady bonds. I don't know if you're familiar with those.
Yeah, for sure. Yeah.
During the 80s, there was a wave of defaults in Latin America. A lot of U.S. banks were on the hook for these, especially Citibank, Chase. So they were going to be pulled under and wiped out. So in an effort to save the U.S. banks, the Treasury and the U.S. government bailed out the sovereigns. The sovereigns were able to pay back the banks, and these loans were securitized and sold off. And the reason they're called Brady bonds is because this whole thing was negotiated by Treasury Secretary Brady.
Right.
And the kicker was they had a 10%, I believe it was a 10% implicit guarantee by the U.S. Treasury to sweeten up the economics of the deal, so that it would attract more investors. So at the time, a lot of this stuff got repackaged and renegotiated in the early to mid '90s, and there was a boatload of money being made because the spreads were so wide. We're talking 2 or 3 point spreads, 5 point spreads on some of this stuff. A lot of the Mexican debt, the Brazilian debt. A lot of the benchmarks. Anyway, so I was there right in the thick of that.
That's awesome. And so you're just this young person on the trading desk.
Yeah. So technically I was what's called a sales trader. So, I wasn't writing a position book, but I was, intermediating trades with traders, talking to clients, talking to institutions, talking to different parts of the bank, the private bank, and providing them with flow. So I had to learn the product, had to learn learn the whole universe pretty much for that product.
That's awesome. So how long did you stay there, and what was your next move?
So I was there for about a year, and then after that, I went to cross asset sales within the private bank, and expanded the product offering. And then after that, so I did another year there, and then joined a team at UBS where I did pretty much the same thing, different client group, more kind of hedge fund type clients, all offshore. So I did that for a couple of years, and I went off to grad school. I'm a Badger. Went to University of Wisconsin-Madison.
Right.
So I had to just borrowing on my experience from Paris, where I had a really good time. Now we're in the early 2000s, and what's the big thing in the early 2000s? It's Asia. China opened up. They got most favored nation trade status with the U.S., and things are just booming. So I'm like, I got to be in Asia. So I actually, even though they don't, in fact, they discourage it. At the graduate level, they do not encourage, at least then, taking off to do study anywhere else. They want you to finish your degree there. But I found a loophole and made my way to Singapore, and I was at NUS, National University of Singapore, and I did my final studies there. Took international finance, international economics, game theory, with an eye on potentially staying in Asia afterwards. Wrapped up my MBA. I literally wrapped up my MBA in Asia. The credits transferred. I got the degree issuer is still University of Wisconsin-Madison.
Right.
But had a job offer in Hong Kong, and there was a death in the family that motivated me to come back. But before I did, I kind of stayed in Asia scuba diving for a while, then once I was done with that,
where do you do that? Like, what's the like? I know Australia is good, I believe, and so where do you go in Asia?
Well, it depends where you are. I mean, Asia is obviously huge. I mean, Australia, believe it or not, is an 8-hour flight from Singapore. It's really far.
Right.
I didn't make it to Australia. But the easiest, closest one was I'd go to Malaysia. I'd take a bus, and after take a bus to a small little port town called Mersing, and from Mersing take a boat to an island called Tioman Island. It's in the South China Sea. Yeah, that's where I got my scuba diving certification. I'd also go scuba diving in Thailand.
What possessed you to do this? Was this something you always wanted to do, or you tried it once and got hooked?
It was something I just wanted to try. I tried it once in Cancun in Mexico a long time ago. Before that, and I never. It was one of these. They call it a discovery dive. So you're kind of you really don't go too deep, and you're tethered and blah blah blah. It's kid gloves kind of thing. And I wanted to get my certified. So PADI, I forgot what the acronym stands for, but they're the issuing body of certifications. And so I wanted to get my certification, and it happened, and it was great. Scuba diving and hanging out in Malaysia. Also went to Thailand a lot. Went to Koh Samui. I went to Koh Phangan. I don't know if you're familiar. Do you remember that movie, The Beach, Leonardo DiCaprio?
Yes. I remember the movie.
That all night beach party.
Yeah,
that's actually a real place. It's called Koh Phangan, and they have.
I thought they closed it now. I thought it was you're not allowed to go anymore because it got too popular.
I mean, this is 20 plus years ago, so maybe actually 19 years ago. So maybe it's been closed down since then. But back then, I was able to partake, and the beach town is called Hadarin. So I'd get a place in Hadarin and stay a few days there and do the full moon party thing, and then go scuba diving or hiking or whatever. So
that's awesome.
Yeah, it's fabulous. It's great. It's time of my life. It's like, and spent some time in Japan traveling, spent some time in Hong Kong.
All right.
And then it was time to get back and be with my family. And then at that point, I'm like, you're out of grad school. All my friends are getting jobs, moving on with their lives, and I'm still doing nothing. And so I came back to New York. And, I left UBS on good terms. No problem there. So it was pretty easy to just come back and get a job. It was in a more senior position, but doing essentially the same thing. Then my team went off to, we got bought out. I went to Morgan Stanley.
Okay.
And because of my Spanish, I kind of separated off from my team, and I started covering middle market financial institutions in South America. So that means like banks, insurance companies, actually some of the smaller sovereigns. So the Central Bank of Bolivia, Central Bank of Uruguay. So that really broadened out my macro perspective, because I went from just, you're buying a bond to now really getting into how sovereigns and central banks manage their reserves, what their goals are, what they're trying to accomplish, how they're trying to manage their trade balance, and how their dollar holdings goes into that. So,
do you remember the first point where you were like, geez, this central bank is a lot different than my XYZ client that I'm usually dealing with? Like the kind of the moment, the light bulb moment, or what were the biggest surprises dealing with those central banks?
I think the biggest one, and I'm still trying to wrap my head around it, Argentina, because at the time, Argentina defaulted in, I think, 2001, I believe. And there were some lawsuits, and Argentina actually confiscated their local dollar deposits. So if you were an Argentine depositor that had dollars in a Argentine bank, overnight those went kapoof, and they were basically expropriated from you, and you were given pesos in exchange. They call it el corralito. El corralito stands for, it's kind of like a corral. So when they say, what's that? The Western movies, the OK Corral. Corralito is basically I'm having a brain fart translating it, but these deposits got confiscated, and then they started a black market appeared for the true value of the dollar, and so now you got a kind of a parallel financial system running. To this day, they call it Mercado Blue, where you have the official exchange rate and then you have the unofficial exchange rate, and so it's kind of Kafka-esque, if you will, in that you have a parallel, an official and an unofficial economy, a black market economy that's operating in broad daylight, basically. It's a really bizarre situation. And so that was, and then, there's convertibility issues, and because they placed capital controls to keep dollars from flowing out. Moving capital couldn't move freely into and out of the country. So it was just a really hard place to do business. And it was just, nothing worked in the way that you would expect it to work anywhere else. So that's the big moment of like, oh my God, this is a really different operation down here for a lot.
All right. And so from there, what were your next steps?
So I did that for about 6 years. And it was good and bad. The cool part, especially in the beginning, was all the travel, right? So like, I'm flying down to Lima, I'm flying down to Bogota, Colombia, I'm in Chile, I'm in Uruguay, I'm in Argentina. And it's fun and it's great. And then after a while, that kind of lifestyle just sucks the life out of you. When they get to know you at the airports and the hotels, and you know all the flight staff and the attendants, and it's just, you become friends with all the people on the travel chain. It just kind of like, all right, this is a little wild. This is not healthy.
That's the point where you question your life choices.
That is exactly it. But it was great. I learned a lot, met a lot of interesting people, and had a great time. Racked up, million miles points on my, whatever.
So then I didn't realize this Pinebrook Capital Management, it's been going since March of 2015. So what is Pinebrook, and what do you do there?
So let me finish. So then in 2013, I left Morgan Stanley. Really my boss left, which means I left. And then I was at a point where, started the whole Pinebrook thing. I didn't want to go back into sales. I didn't want to go back into being a road warrior and traveling. I was done with that part of my life. Now I'm pushing 40, second kid's on the way, and decided to not go back to that. And so took some time off. And then, Pinebrook is really a personal holding company, a personal vehicle, tax advantage vehicle to, run manage my money, some friends and family money, and, a couple of former clients. And that's it. So I do have the holding company, and I have a hedge fund vehicle. And I also have a relationship with Interactive Brokers where I can run some separately managed accounts through them. But I have chosen to not seek outside money because it's not what I want to do.
Okay.
I don't want to run money for other people at scale. I find that to be just a giant headache. And it would take the fun away from what I'm doing now. So what is Pinebrook and what am I doing now? So Pinebrook, as I said, is a holding vehicle to manage some personal money and some friends and family money. And that's what I do. The writing project, it's been a long time in coming. I actually had an old blog back in 2014, I think it was. You could probably still find it, but I'm not going to say because I'll cringe at the stuff I wrote. And, when you first, writing is a craft like any other, and when you start, well, it can be rough. But I started blogging and did that for a while, and then I got distracted. Third kid came along, and between family demands and managing the money I was managing, I didn't have time for writing. And then I found Twitter around 2000. Right around the same time, 15th, I think. My old account, Pinebrook Cap, got canceled. But
what happened there?
I made an ironic joke. Someone was talking about what to do in the event of a nuclear holocaust, or I think the subject matter was bunkers. That's right. Someone was talking about spending gobs of money on all these bunkers, and you get to survive. And I'm like, why the hell would anyone want to survive and come out of that and come out into a post-apocalyptic world? What do you do? What do you do when you've got maybe a year or two of living supplies in your bunker, and then you come out, and then what? And so it was kind of a thread going, and then I think I said I'd rather just find the nearest cliff and jump, and that got flagged for encouraging self-harm.
Seriously, like you said that about yourself?
Correct. I think I would just find the nearest. I have a screenshot of it.
And that got you canceled.
And there was actually a user report. So there's a nefarious element. I think I have the screenshots where it says, due to a user report, we're suspending your account.
Oh, so somebody was hunting for you. Okay.
I think someone, maybe I offended someone, which is probably not surprising. And they found a weak spot and tagged me. And then, my wife's an attorney, and, the way she explained it to me is, look, from their standpoint, they don't need someone does something goofy and then hurts themselves, and they got to defend it in court because they didn't take you down. So from a corporate standpoint, they did the right thing of shutting you down and making the problem go away.
Was this pre-Elon, by the way?
No, this happened in January. And it's my brother's birthday. That's why I know it happened January 19th this year.
Of this year? Oh wow!
Yes, I had close to 18,000 follows.
Okay. Anyways, go on. So we got kind of sidetracked there. We should probably talk more about marketing.
So I started writing. I started just blogging.
Mm-hmm. Yeah.
And then over time, I just started blogging more on Twitter. Creating content and contributing more and more. And eventually, it kind of took a life on its own. And I got a lot of encouragement from some people. I actually did some podcasts starting in 2021, I believe, or 22. And then from there, it kind of took a life of its own. I started writing more content. And then I launched a newsletter in late September last year.
Okay.
Yeah.
All right. So let's talk about your views and about the market. I think it's great because I think you have a tendency to debunk a lot of the crap we hear on Twitter. And there is a lot of it. So why don't we start with your kind of philosophy or the way you think about inflation? Because I think it is rather unique. And one of the things that everyone always loves talking about is M2. When it was going crazy, 2 years ago, everyone thought there would be tons of inflation, runaway inflation. And although we did have inflation, once the M2 collapsed, they thought that we would now have a depression and the economy is going to collapse and it's going to be ugly. And yet here we are kind of still waiting for the collapse of the economy because M2's collapsed. So why don't we first kind of hit that, why you think M2 is not the indicator that a lot of older folks or not even older folks, just kind of traditionalists might follow.
Yep. So there's two things about M2. But first of all, money, more broadly speaking, and this is probably not going to win me a lot of friends, but I see money as a residual to the real economy. It's kind of a byproduct of the real economy, and the state supplies it based on the needs of the real economy, and sometimes they oversupply or undersupply, but it's really at the margin, I think. And what really matters is real economic activity. Actually doing something productively. And money is a residual of that. It allows us to transact and it allows, store of value, blah, blah, blah. But really, when you get down to it, it's a residual. And I think that's why, a lot of economic textbooks don't even consider money. I mean, if you take a principles class, right? If you go back to your principles, Econ 1, they really don't talk about money. I mean, I know there's money in bank, and I've taken a money in banking class, both at the undergraduate level and the graduate level. So I do see that money does have a role in the banking system, and but for long run economic activity and long run economic behavior, it's really kind of a residual. It's kind of endogenous. It doesn't really matter. So I don't. If I see M2 jump up, it's not causal. It's an effect of other things, but it's not causal. And we saw in this cycle where, we didn't get an inflationary supernova, nor did we get a deflationary depression. Secondly, M2 is just a horrible, horrible, flawed indicator. And the reason is, it doesn't take into account the moneyness of other mediums of exchange, right? So, I don't know what the exact equation is, but it's like, coins, currency, checking accounts, whatever. But, the financial system has evolved so much since M2 as a concept was introduced. There's a new measure called Divisia M4.
Okay.
And it's a broader measurement of money. What does that mean? It means it takes into account things like repo. It takes into account the duration of treasuries in the system. It takes into account the moneyness and fungibility of different instruments and how quickly they can be converted into liquidity. So I haven't gone into the nuts and bolts of how they do it, but I do understand as a concept that if you want to talk about money, you can't just talk about, the cash, coins, currency, and checking accounts. You need to take into account everything: stocks, bonds, and their relative weights and their relative convertibility into fungible money. Right? A 1-month Treasury bill has a lot more moneyness than a 10-year Treasury note.
Okay.
You see that?
I hear what you're saying. So when Milton Friedman famously said inflation is always and everywhere monetary phenomenon, do you push back against that?
There's some historical precedents for it, right? We all hear about, stories of the Roman Empire. The reason the Roman Empire went down was because they debased the currency, and
right.
Weimar Germany. But I think that's a residual, right? Those are really political problems. Those are political choices. Just the way that we conduct monetary policy is a political choice. Money might facilitate it. It might be the means of expression of it. But ultimately, I think inflation is really, there are three big causes of inflation, and it has very little to do with money.
Okay. What are the three?
War.
Yeah.
Pestilence, COVID, things like that. Or, war, natural disaster. You can put pestilence in the natural disaster bucket. So,
okay.
War, some kind of natural act of God. and the other one is political dysfunction.
Okay.
And those are the three things that really create inflation. It's not money printing, it just enables the dysfunction. It expresses the dysfunction, but the dysfunction originates not in the money printer. It originates in the political decision to monetize debt or to do whatever that raises inflation. So you think of a place like Zimbabwe or a place like Venezuela. There's gobs of money circulating around. There's no doubt about that. But is it causal? What's the root cause? And the root cause, if you look at it, is really political and the political choices that are made. And the money thing just papers over the political choice. So
fair enough. Okay, sorry. Let you finish your thought.
Part of my framework and this applies to all of my framework, is I try to really go into causality and not just, all right, what's the surface level? So, here's a great one, the yield curve, right? The yield curve causes a recession. Does it? Does it really cause a recession? I don't think it does. I think what an inverted yield curve tells me is that inflation today is higher than it will be tomorrow. That's what an inverted yield curve tells me. It tells me nothing about an incoming recession.
Do you think it actually tells you that inflation today is higher than it will be tomorrow, or that market participants believe that inflation today is higher than it will be tomorrow, which is two different things?
If you want to get down to that level, what it tells you is the policy rate is higher today than it will be tomorrow.
Oh, policy rate. Okay, fair enough. Okay, yeah, I follow what you're saying.
So this part of my framework is really trying to get into causality and explore causality and understand what are the real drivers. Another one, for example, is in 2022 when interest rates started mooning and housing sales went to zero pretty much. Everybody said, oh God, the economy's going to crash. That's it. It's over. Game over. Recession, housing. That's it. And there is some truth to that, because 7 out of 11 post-war recessions have originated in the housing market. Okay. So we have a limited data series, 7 out of 11, but now we're starting to conflate something that happened with causality. And so in 2022, late 2022, I started noticing that despite housing sales having pretty much gone to zero, what was really happening that had economic consequence was not the sales. In a sale, there's no real economic activity that takes place. Maybe some broker, skims off the top a little bit, title people, insurance people, agents, but nothing really of economic significance happens when a house changes ownership from, let's say, me to you. We didn't create any real value. We transferred title, but we didn't create real value.
Fair enough. Understood.
So, housing sales going to zero, I didn't see as having an immediate economic consequence in the context of housing construction and housing construction employment being at all-time highs. And that's what gave me the confidence to go get bullish in November of 22, get off recession watch and get bullish, because I was able to not conflate a coincident activity, sales, with a real economic driver, which is actual construction of units. So, my view was that the housing market underlying the frozen sales was actually booming, and being it was going to be additive to GDP in the future, because what happened during the pandemic was, because of supply shortages, a lot of projects got stalled, but workers weren't laid off. They were furloughed maybe, but they weren't laid off for cyclical reasons.
Right.
Once supply started coming back on, workers came back to work and built the houses that they're in the middle of building before the pandemic.
Do you think that this conflating like causality is also evident in the soft data versus hard data debate that's going on Wall Street?
Absolutely. So and that was another thing I tweeted a lot about in my old account was, the bullwhip effect. A lot of these soft data, they're survey based, right? So if you're
people don't understand. It's just basically people's opinions.
So they ask you, well, how do you see productivity coming up? Well, I'm out of supplies. I'm not producing anything. Okay.
Yeah.
So, we take this idea that nothing's going to get produced and, oh my God, production is going to go to zero and that's it. Game over. Recession, economic activity is, going to go to hell in a handbasket. But what we saw was these bullwhip effects where purchasing managers and supply chains, the supply chains were strained. And you had to over order to get what you needed for past orders. So then you get these burst of commodities delivered, and then you had to over order, so you had to wait, and so you had these kind of like very volatile gaps in the supply chain, and I think that caused people to think, "Oh my God." Orders are gone to zero, production's gone to zero, not realizing that the causal mechanism was not lack of demand, it was lack of supply. So that's another instance in which searching for causality in the context of what's going on in, broadly speaking, what's happening in the economy, I think can be a real edge. And that's what has helped me a lot in my macro. Is understanding causality, and the causality could change from one cycle to the next, right?
Right.
Maybe it works this time, but it doesn't work next time.
Do you think that there's, because of the amount of fiscal that we've done on this recession coming out of the COVID versus, for example, the great financial crisis or the previous recessions where they were almost all monetary based, that the nature of the economy has changed and therefore there's more likely to be people misinterpreting it?
Absolutely. I mean, you got to remember, we had the greatest fiscal stimulus since World War II. I think it was 28% between the all the packages. It was about 28% of GDP. I mean, this is gargantuan. This is crazy. I mean,
and the other thing is, as like I'm a Canadian, but you're American, like the U.S., they did by far and away more than anyone else.
I mean, just think of the scale. California alone, if it were its own country, would be the 7th largest economy in the world. Okay, yeah. Texas is right up there, New York, Florida. The scale of money that came out of Washington is unfathomable. Not only to people in this country, but to people outside of this country. They just can't. I mean, you're talking, even the larger economies, UK, France, Italy, but then you get into smaller countries, Austria. I mean, my God. I mean, Austria's economy is a rounding error for us.
Right.
And they just can't conceptualize it. It's crazy. Yeah. But to answer your question, the answer is yes. There has been a permanent, for now, I mean, I'm permanent to big words. I shouldn't use permanent, but certainly cyclical impact in that, all this money is being deployed and we have a stretched labor markets, and there's kind of for now, a virtuous cycle where due to the tight labor markets, companies are being forced to innovate. Right now, our productivity is the highest we've seen in a while. I don't know exactly for how long it's been, or how long it's been since, but it's certainly, part of the dialogue of productivity. It may not be higher on a secular level, but it's certainly higher on a cyclical level. And, productivity really is the mother of economic growth.
Which is back to your point about the real economy.
Correct. The real economy, not just economic growth, real economic growth, where you can still have disinflation and still have positive growth. And that's something that a lot of people have had trouble with wrapping their heads around in this cycle, that, oh my God, we have strong growth, we're going to have inflation. And the complete opposite has happened.
Well, we did have a bout of inflation, but so yeah. But I guess what, to your point, the growth has recently, especially in the last year, been outpacing inflation. We're having real growth.
We're having real strong economic growth,
Right.
for sure. And some of that's mechanical, right? Where if you have disinflation, real growth will be kind of mechanically higher in the near term. I wouldn't be surprised if they're in 5 years, which for traders and investors doesn't really matter. But I wouldn't be surprised if the eggheads downgrade some of this current growth. But that's academic and it doesn't matter for us.
Right.
But I wouldn't be surprised that, some of the growth that we're seeing is somewhat of a mirage, but not in a bad way that some people would say, oh my God, it's all fake. It's all money printing. It's all deficit spending. I don't mean it in that way. It's a measurement error. It's not some kind of conspiracy. It's a measurement error.
Back to your point about the fiscal stimulus. And one of the things that I've been struggling with is the fact is everyone says, oh, that was all, the fiscal stimulus was money in people's jeans and it's about to run out. We're running out of savings. And that's why the economy is going to roll over. And I look at this IRA, this Inflation Reduction Act, which is kind of an oxymoron, but in terms of like jumbo shrimp. But I look at it and I don't think people understand or appreciate how large that is and how much of an industrial policy change has occurred. And I was wondering if you've given that any thought and how much that plays a role in terms of your expectation about growth going forward.
I think it's played a huge role. We see some monster numbers. We saw some monster numbers last year with respect to the construction of manufacturing centers. Construction manufacturing just moonshot, right?
Right.
And that was one of the things that not only strained the supply chains, but also kept general construction employment high. I mean, it's not totally fungible. In other words, someone that building houses is a different skill set than building a complex manufacturing facility.
Right.
I mean, there is some transfer of skill. Screwdriver's a screwdriver, but there is there are some frictions in transferring the skill set across the domains, but that is still there is a gargantuan amount of money that's going into reshoring. I think there's a geopolitical element, not just on the computer front, with respect to China and chips, but with respect to a lot of things. And I think it's a policy pivot by the current administration to, I wouldn't say deglobalize, but certainly uncouple somewhat and not be so dependent on China. I think that's a strategic move.
Yeah. And do you think it's going to continue to drive real growth in the coming years? Like, what I'm asking is, do you think that the benefits that everyone thinks are behind us are in fact behind us, or is there still more of that stimulus to come in the coming years?
I think there's still more to come in the coming years. I haven't done the numbers in a while, but if my recollection serves me right, and I wish I had access to my old Twitter account because that did have the numbers. A large part of the IRA had not been spent as of the middle of last year. It's just you just can't deploy that kind of money that quick. It takes a while to spend trillions of dollars.
For sure.
Short of doing a helicopter, to deploy to get a project shovel ready from design to permitting to acquiring people and know-how and blah blah blah. I mean, this stuff takes a while, and that money is going to keep trickling through the economy for years to come because it takes that long to deploy that kind of money at scale.
Okay,
short of a war. I mean,
right.
A war is a whole different thing. But short of a war, it takes a long time to deploy trillions of dollars in money.
So one of the things that you've been kind of highlighting here is the fact that you believe that we're experiencing real growth. So how do you change, and how has that affected your asset mix? And what are you doing going forward based upon that belief?
So the answer is I've been very bullish on growth. So I've been, as we would say, risk on. So, very long equities and I've also, because I do believe in disinflation that's been happening. I've been, I did get bullish on bonds on November 1st, told subscribers to get long the 10-year. And we did that. And then we took some chips off the table, got neutral. But generally speaking, I do think that we are, I don't know if we'll head back to, 1.7 like we were. I think we averaged 1.7 core PCE before the COVID crisis.
Right.
I don't know to 1.7, but I think we'll get to close enough to 2 where the benefits of running a little warm will outweigh the cost of it. And what do I mean by the benefits? Full employment, a strong labor market, which will smooth out volatility in the business cycle. The answer is leaning towards growth and leaning towards risk on.
So when you lean towards growth, unfortunately, or not, maybe unfortunately for you, a lot of it is AI these days. So does that mean like growth in terms of like traditional economic growth, or will you pick the growth stocks that are kind of running right now like they stole something?
So the answer is, as a macro strategist, I don't start going deep into sectors. I kind of look at the big basket and I just buy the index. I keep it simple.
Okay.
I have neither the expertise nor the time and resources to sit there and shift through sources and individual stocks. I think it's a lot easier to just say, I'm going to deploy capital to whatever index and let it ride. And it's worked out. I did do a little sector picking last year with the housing sector. I went very long housing stocks back in February of 23. And that was only as a result of, looking at those economic linkages that we were discussing earlier in the program. I kind of stumbled upon that and made a kind of a lucky find. That was the one area last year that really just hit it out of the park. And I rode it for most of the year. But I would think that was more of kind of a coincidence, I think, as opposed to just, I'm so smart and I found the right spot. It just happened to be a function of, I was looking at the economic contributions of the housing sector on the economy, and I stumbled upon that sector.
So you mentioned sectors, and one of the things in your report is that you actually talk about the rolling 30-day S&P sector correlations. Why don't you explain to people why you watch that and what that's telling you about the market?
Yeah. So typically, when correlations are high, it's kind of a risk off where, it's the old, you throw out the baby with the bathwater. When you're de-risking, you sell, you don't sell what you want, you sell what you can. You have to just get out. So things, in a situation like that, correlations go to 1, everything's getting hit. So when correlations are high, that suggests very risk off. When correlations are low, that suggests that different parts of the economy are doing okay, and investors are picking and choosing amongst the available options to deploy capital. Obviously, when they get really low, then either extreme, you're going to have some danger points. But if you pick your, I think in my report I have the mean is, I believe, 0.83. And you pick your standard deviation bands above or below that, then that can give you insights into the general feeling of the market, how investors are seeing the market. It's one of the tools I use. I also look at credit spreads a lot. I look at not just high yield or investment grade, but I like looking at what I call the trash spread.
Okay.
The trash spread is basically the spread between, the lowest junk triple C versus the broader high yield index. And the reason I like that is because, triple C is very twitchy. It's very neurotic. It's very, these companies are, a breath away from bankruptcy.
Yep.
And if they can survive, then things are probably going to be okay. And I look at how they trade in relation to the broader high yield index, and that can yield some insights into how investors feel about the macro cycle.
I think I follow that chart as well. So I have the triple C's versus the triple B's. Is that in that sense doing the same thing?
Correct. I don't have it in front of me right now. Literally, actually, I probably could pull it up.
Well, so it is down. It's down. But what I was going to ask you about is that it's. I think one of the big surprises for a lot of people has been how well credit has performed. Like it just continually remains bid in terms of those OAS spreads going down and down and down. That's another one that's probably surprised people. But I take it you aren't surprised, and you think even like, do you invest in that, or do you just use that as an indicator for choosing what to invest in?
I use that as an indicator. I'm not trading. I think trading bond indices is kind of more of a sophisticated institutional product, and I don't have, I don't have the, I don't have an ISDA, I don't have a GEMRA, Global Master Repurchase Agreement, or the right tools to be doing. I mean, I guess you can do it with ETFs, I guess, but that's clunky and inefficient. But to your point, I do look at it as an indicator. And right now, for example, the trash index, I haven't updated in a week, but as of last week, February 29th, the spread was 551. And you go back all the way to 21, that spread was 327. So if the cycle continues, there's a good shot that this thing keeps tightening up as well. I think it will continue. And it's obviously subject to investor confidence on how tight these spreads get, but I think there is some signal value in following these kinds of indicators.
So you're not surprised that there hasn't been more defaults?
No, I think a lot of debt was termed out before the increase in rates, not only at the individual homeowner level, where I'm one of the people that has the low mortgages, and I'm sure a lot of people are. Companies did that as well. I mean, everyone talks about the maturity wall, but I've been hearing about the maturity wall since I've been on Wall Street, and it's one of those things that it's the animal in the forest we've never seen, right? But we're sure it exists. Right. We've seen the footprints, but it's like Sasquatch, right? We saw the footprints, but we haven't seen Sasquatch yet.
That's right.
I have seen debt maturity profile charts and blah blah blah, but I think a lot of debt's been termed out, and you got to remember too, though, companies don't place debt at following treasury levels. They have hurdle rates for their capital expenditure projects. They have hurdle rates far in excess of what the treasury will do at any given point in time. So if you're an issuer, your CapEx plans take into account 50, 100, 200, 300 basis points rise in treasuries. That's just part. If you're a CFO and you're not thinking about that when you're terming out your debt, then you're not doing your job, and you'll be fired.
Right. One of the things that I noticed as I read your research is that you really do believe inflation's coming in, and that we're going to be back to kind of the old days of 2% before we know it. But the other thing is I noticed that you think about the Fed, their reaction function to inflation is different than many. And I thought maybe you could talk about how you believe the Fed looks at inflation and tie that into labor.
Well, they have a dual mandate. And I think a lot of people think that growth is their mandate, and growth is not their mandate. Their mandate, their statutory legal mandate, to which they are accountable to Congress and to the law, is to promote a healthy labor market and low inflation. I mean, they don't have a codified 2% target. It's kind of an informal target, but you have to contextualize the balancing of the dual mandate. You can't just say, okay, they want 2%, they're going to get 2%, and that's it. They have to do that and balance out the demands of the labor market. And, one of the problems with the labor market, I wish I could show the audience the charts, but whenever unemployment rises by more than 1% in a year, there's been a recession.
The Somme rule, right?
No, that's not the Somme rule.
Oh, what's the Somme rule? I forgot.
Somme rule is when the 3-month moving average of U3 moves 50 basis points above the annual average, I think.
Okay.
She's gonna get. I know Claudia. She's probably gonna get mad at me if she hears this. But
well, she can come on and teach us properly.
I actually run it, and I have it into a model.
Okay.
So I just kind of lazily enter it, and the model spits out, whether my Somme rule number. But that's not to be conflated with the Somme rule.
Okay.
But historically, if unemployment rises by 1% in a year, it continues to rise. It doesn't stop at 1%.
Okay.
Okay. And a recession always follows after that. It always has. So the Fed, I think they have a little more wiggle room with inflation, where they can say, okay, we can give inflation the benefit of the doubt. There's a little more wiggle room with that than there is with the labor market. Once the labor market cracks, it's game over. There's just you cannot put the toothpaste back in the tube like you can with inflation. We had a bout of inflation a couple of years ago, and we're still dealing with it, obviously. But back then, had they said, okay, you know what, overnight we're jacking rates up to 15%, and we're gonna go full Volcker and just take care of this. Guess what? You'd have a recession pretty quickly. But so I think the Fed catches a lot of flack for, they're dragging their feet, or they're doing this, or they're doing that, and inflation, and oh my God, we're going to have the 70s all over again. And I think that needs to be contextualized. Well, first of all, what's the causal driver of inflation, and second of all, it needs to be contextualized with the dual mandate of the labor market. So, if in pursuing an inflationary target, it breaks the labor market, then the Fed hasn't done its job.
Fair enough. And that's one of the reasons that, like, the ECB, on the other hand, doesn't have the dual mandate. They only have the 2% inflation target.
Correct. They have a single mandate. I mean, there's a whole set of problems with Europe. I mean, there's lack of a banking union. There's lack of a federal budget. I mean, the European Union is half pregnant as an economy, and that's really their big problem, is they're half pregnant. Versus the Fed does have the dual mandate, and that, on the one hand, you can say it shackles them, but on the other hand, it gives them more flexibility.
Doesn't it therefore mean that they're going to err on running hotter over time?
It really depends. It depends on where is the labor market, and it's also political, right? Because if you think about what happened after the global financial crisis, the Fed persistently missed its inflation target. Core PCE averaged 1.7. The target's 2%. So despite QE and all these people, especially there was a big group of very important people, big names that with big reputations, that wrote this letter to the Wall Street Journal and published it and said, "Oh my God, Ben Bernanke, you can't do QE because we're going to have an inflationary supernova and the dollar and this and that." Well, guess what? Despite all that, the Fed still missed its inflation target to the downside.
Yeah, but isn't that a function of the fact that we knew, and I think Bernanke did understand it at the time, because he was begging for fiscal?
Correct. We did know that.
Well, some people knew it at the time. And the point is, though, now, is it not the problem that we have the opposite, where fiscal is kind of we're too quick on the fiscal and it's a little more persistent? And so that does it. And so I guess that's where I struggle with I agree with a lot of your thinking, but I have trouble with the idea that inflation is going to go back down to 2%, because I worry that at the end of the day, I don't worry about the Fed doing QE. I don't worry about them. I don't think they actually control inflation as much as they think, but I do believe that fiscal can influence inflation. And
I agree with you.
Okay.
I do think, though, however, that inflation is going back to very early in this program. Inflation is a political choice. It's a choice that policymakers collectively make. And, the Fed, despite all this other independent, blah, 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 the Fed is an arm of the government. The Fed is an agency of the U.S. government. It is part of the sovereign. It's not independent. I don't care what they say. I don't care what anyone says. They are not independent.
I completely agree with you.
So as an agency of the government, they are susceptible to the policy goals of the administration. Now, there's some little room for wiggle, and there's optics, and there's blah, blah, blah. But generally speaking, they're going to enable the goals of the administration, whatever, regardless of who's in power, whether it's, Biden or Trump or whoever. And, again, there will be some wiggle room, but I guess going back to your statement about will inflation go back to 2, that's a policy choice. And it's a policy choice that has to be made in the context of the broader political economy. What do I mean by that? I mean, where are we in the election cycle? What's the unemployment rate? What challenges is the economy facing? Ultimately it's a judgment call. This is why I think Powell is such a great Fed head, is that even though he's not a trained economist, he's a trained lawyer. He's making judgment calls. He's got an army of advisors. He's got an army of experts. He can, he's got the top of the food chain in terms of brain power to speak to and get their counsel. But ultimately, Jay Powell is making a judgment call. And that judgment call is predicated on all these other things I mentioned, policy goals and the context of those policy goals. So can we get to 2% inflation? Sure we can. Will we? I don't know. I think that's predicated on these broader factors.
Oh, I see. So you're not confident that that's where we're headed. You think that that's the likely outcome, but there is a chance that inflation does pick up and we run at 3%.
The answer is I agree with the first part. I think 3%. I don't think 3% is politically viable. I think a 2.2, a 2.3 is politically viable.
Okay.
Well, within the handle, the 3% stuff becomes toxic, right? Then if you're running for president, if you're a policymaker, how do you defend 3%? Like, it's tough. When food and gas are going up, and things that we can get academic into all the nuances of how inflation is measured, OER and blah blah blah. But for the average person, inflation is really how much money am I spending? How much nominal dollars am I spending, and how much of it am I keeping?
So
I don't think 3% is politically viable.
Okay. So when you argue that they might run it a little hot, you're talking 2.2, 2.5, not 3.
I think 5, even 5 is a little high. I think 2.2.
Okay.
That they can fudge it there and be like, okay, we're getting there next year. But I think 2.2, 2.3 is within. It's basically the symmetric opposite of what happened before the financial crisis, where we were running below at 1.7. So if you're looking at symmetry, we were running 30 basis points below. And the symmetrical opposite of that would be 30 basis points above. So
David, you're bringing back flexible average inflation targeting.
I am. Yeah, that's a 4-letter word, right? It actually really FAIT. It is a 4-letter word.
All right. So tell me as well what you what other things you see in terms of when you're setting up your portfolio. What other things might excite you right now?
Yeah, I mean, I'm not a sector picker, but one thing that I think we're gonna see a lot more of is nuclear. I think wind power is just it's not really economically viable without it just doesn't. It can't pay for itself, right? It runs on subsidies, and there's a huge environmental impact with wind, and similar with solar, the batteries, and I'm not an environmental expert, but I think the cleanest, most scalable, renewable energy resource we have is nuclear.
Okay.
And nuclear became a 4-letter word after some high-profile problems. Those problems were not inevitable. The U.S. Navy, the nuclear fleet of the U.S. Navy has never had a nuclear incident, ever. Why is that? Why did Chernobyl happen? Why did 3 Mile Island happen? Why has the U.S. Navy never had an issue?
What is it? Tell us why.
Well, I mean, I'm not an engineer. I don't know why, but I will tell you, it just comes down to procedures and doing it right versus doing it wrong, being sloppy versus this is something that has low margin of error, and you can approach something with high tolerances or low tolerances. And I think now that we understand that nuclear can be safe, I think it removes a lot of the taboos that existed around nuclear in the 60s and 70s, and that a whole generation of people that will soon be dying off will not vote against.
Right.
And I think we've seen what happened with Germany too, right? Germany was huge on nuclear, and then the green agenda, and I don't want to get into the environmental politics, but they basically went denuclear, got very dependent on Russian energy.
Didn't work for them that well for them.
Yeah, exactly.
Okay, so let's take it back.
I think nuclear we're going to start seeing a lot more of that is the answer.
Fair enough. We'll take it back to the macro before we finish off with our questions. The US dollar, we haven't talked about that at all. I
don't talk about it.
Really? You're like the Treasury Secretary.
I don't talk about it.
Or no, not the Treasury Secretary. Treasury Secretary is allowed to talk about it. The Federal Reserve's not allowed to talk about it.
Correct.
Why don't you talk about it? Can I just I'd love to know your reasoning behind that.
What's there to talk about? I mean, meaning obviously it's the reserve currency of the world.
Yep.
There's no alternative. What's there to talk about?
But what you have to, as a macro strategist, when you're thinking about potentially investing in other countries, that has to be a factor. Whether the dollar is going to affect it could obviously drive the inflation rate. There's things to talk about. Maybe you don't trade them, or maybe you think that they're overblown and over kind of emphasized. And I understand that argument, but I just love to know why you're so just like, nah, I don't want to talk about the dollar.
I think trying to game out the dollar is mostly a fool's errand.
Okay.
It's a highly efficient market.
Yeah.
And it really comes back to what can be gamed out is terms of trade and real economics, real trade flows. But trying to are about changes in the dollar, and some people can do it. I'm sure there are some people that can. But I think, again, going back to money, it's kind of an exogenous residual, right? It's kind of what the dollar does is really a function of what's happening in the real economy. So that's why. So I view, kind of the analogous to how I view M2 and money in the domestic economy. It's the same kind of approach I see with the dollar in the international economy. It's a residual. It's endogenous. It's a transmission mechanism, but it's not a causal driver itself.
Got it. Okay. All right. So let's end with the 3 questions. First of all, what do you think the hardest thing to do in trading investing is?
I think it's reconciling opposing truths. So, we're dealing with that with, this whole subject of Fed cuts and disinflation and the labor market and growth. How can we reconcile strong growth, a strong labor market, with a Fed pivot to start cutting rates, right? You hear people on Twitter saying, "Oh, they're crazy. We can't cut rates. The labor market's too strong. Oh, we can't cut rates. Growth is too strong." Excuse me. So how do you reconcile those opposing truths? And then you have, in disinflation. Will we reflate? So, I think the way you square the circle is with productivity. Now, I don't want to go into a tangent and make an argument for productivity. I'm trying to make a mental exercise of observing opposing phenomena and finding out a way to square the circle. And that's hard. That's really hard.
I think that's great. That's a great answer. I haven't heard that ever. So that was terrific. Don Cox used to say that you shouldn't invest on what's on page 1 today, but what's on page 16 on its way to page 1 tomorrow. Do you have any trades that you feel would get the Don Cox seal of approval?
I think I conflated your prior question when I answered nuclear. So
I blew it. I'm sorry.
No, it's my fault. Nuclear is, I think whether it's uranium or anything, involved in nuclear, I think Westinghouse and General Electric are the only two places in this country that build nuclear plants. And I'm not making a stock pitch either. I haven't even looked at them. But I think anything associated with nuclear, for the reasons I mentioned about not only the environmental renewal, but also strategic. And also, one things with this country is that we are, I think, in my opinion, the most geographically advantaged country on the planet.
Oh, 100%.
We have a lot of water.
Yeah.
We have a lot of, we're big.
The perfect temperature in terms of like not too hot, too cold between the two parts.
Not only that, the water drainage, the way the Mississippi River, the different river, the way that our water drains into the ocean. I mean, it is just crazy how advantaged this country is. 2 big oceans on the side, on and on and on.
Except for those assholes to the north, you guys got it all going on.
Oh God, it was the worst. I was going to go snowboarding in Canada this year, man. I had to cancel.
I know that. It's a tough year.
Not going to travel in 2 weeks. I think the federal government owns 1/3 of all land in this country still, at least if not nationwide, certainly west of the Rockies. And there's a lot of places that they can put nuclear. It doesn't have to be in your backyard.
Right.
There's a lot of places that they can put nuclear.
Got it. Okay. So our third question is Patrick O'Shaughnessy often asks his guests, what is the kindest thing someone has done to you to help you along with your career? This is such a great question. I'm actually going to steal it from Patrick. Do you have a particular person or event that stands out for you?
The answer is yes. I would say my old boss at Morgan Stanley, Fabian Onetti. So if you're out there, Fabian, thanks. Shout out. Fabian was kind of just he was just a really nice guy and became a mentor, not just professionally, but also personally. And I think the mentor-mentee relationship has to be personal. It can't just be, at the office. I think you need to have a friendship. Doesn't mean you have to hang out with them. Doesn't mean you have to, go to their house every weekend and, awkward stuff like that. It just means that there's a personal interest in each other's lives as people, and that you support each other in that way. So, when I was getting married, I was getting married and having kids and traveling to Latin America. He as a father, he got it, and he did everything he could to really facilitate my career growth while trying to help me balance the demands of having a family. And that meant a lot to me.
That's terrific. All right. And so I got one more question, then we're going to ask you for a question. And now this question was Chris Ritchie from Silvercrest Mines or Metals. He actually left it. And if there was ever anyone that was designed this question for, it is you. So let me play it.
How big of a factor, if any, does, real returns factor into how you build a portfolio?
Chris is a kind of a big proponent of real returns because he thinks too many people just look at nominal stuff. So when you're thinking about your different assets and stuff, how much do you think about it in nominal terms versus real terms?
We live in a nominal world, so I think of nominal.
Oh, you do?
Yeah.
All right. So you just don't.
I don't pay in real. You pay in nominal. When you get paid, when you have your cash flows are struck at nominal rates and your liabilities are struck at fixed rates. And your future liabilities are somewhat, known, but also there's some risk with that. I got 3 kids going to college. soon, or not soon, but they're still youngish, but it's not far. And so I'm looking at that. So in my portfolio allocation, I'm not, I'm not trying to meet a real hurdle. I'm trying to meet a nominal hurdle. I'm trying to make sure I need to make sure I can cut the check and pay the bill. And that bill is a nominal.
Got it. All right. So you have a question you're going to leave for the next guest?
Sure.
Okay.
What's the next iteration of AI? How far is this going?
Oh, meaning that, like, do you, in terms of like the next app for AI, or do you think like the next big kind of technological,
the next use? So in other words, let's go back to, the internet, right? The first Web 1 was all about just getting something online. And then Web 2, I think, was, mobile, and Web 3 is, I don't know what it is, a dinosaur. But, right now, AI, I think its best uses, as far as I know, are, whatever we're running into now, customer service, a virtual bot for whatever, this or that. But what's the next iteration? Are we going to have, are we going to have medicines designed by AI? Are we going to have, is my next visit to a psychiatrist going to be with an AI bot? What are the next crazy applications for AI?
I hope that we get the biggest bear skeptic kind of old money guy for the next one that has to answer that question.
It's going to zero.
Yeah, that's right. It's going to be in the garbage. Some just curmudgeon that just doesn't think that at all. Okay, that's terrific. So before we let you go, David, why don't you tell people about your letter, where they can find you? Why don't you give them your new Twitter handle, since you seem to you've lost the old one and you are using a new one?
What is my new Twitter handle? Let me check it out. Jesus. So it's at Econ Strat PB. So Econ Strat PB.
Right.
Pinebrook. And that's where you can find me on Twitter or X.
Yeah.
And my newsletter can be found at pinebrookcap.com. Pinebrookcap, one word.com.
Yeah.
And I typically publish, I try to keep one publication very regular during the weekends, called a weekly signal and noise filter. And then I do some other market commentaries, kind of ad hoc. But the general framework is to really distill what matters from what doesn't matter. I think we have so much information overload in our sector, and it's my view that a lot of it doesn't really matter. Pick your flavor of the day, your headline of the day. It really doesn't matter. And I try to dispense with that and focus on what does matter and what's a causal driver. Whether it's at the policy level, the reaction function, or the real growth impulse, or the inflation. My focus is really the growth and inflation matrix, because if you get that right, then you can get interest rates right. If you get interest rates right, you can get everything else right. And my goal is to really help people dispense with all that crazy stuff, focus on what matters, provide a framework with the guardrails so they can do whatever they want and not blow themselves up. I mean, I don't offer, I occasionally throw out hey, I'm trading this, I'm trading that, but I'm not a signal service. I think, people's portfolios, people's needs are way too diverse for me to take on that responsibility and tell them to buy this or buy that or sell this, sell that. I prefer to let people choose for themselves but I provide the context for risk management and favorable or not favorable conditions, and help them figure it out.
Got it.
So yeah.
Thanks a lot, David. It was a real pleasure getting to know you.
Hey, thanks for having me. I really appreciate it. I really enjoyed this talk.
Thanks a lot. Have a great weekend.
Yeah, bye.
All right, Patrick, it's time for Talking Charts. It's been a wild week. Lots of things to talk about.
Yeah, but okay, let's go through the top three things we were watching from the last episode. Obviously, the jobs numbers, which there was an uptick, but really they weren't big deviations from the expected numbers. Did you take away anything from them?
No, It was not.
Yeah, it was not non-event. Number two, the global central bank monetary policy. I was looking to see whether or not the currencies would start moving when the ECB and the Bank of Canada came out. They left policy unchanged, but did you take away anything?
I took away that they're complete lightweights. Both of them keep waiting for the Fed. They're checking in with Daddy before they decide to do anything.
It's really synchronized central banking at this point.
Tip Macklem, our central banker, and I don't say this very lightly, he could be the worst central banker since Jean-Claude Trichet raised rates in 2011 because he was worried about inflation.
There you go.
That's how much I think he's terrible.
Oh, okay.
Yep.
That hurts.
You heard it here.
Yeah, there you go.
All right.
Number one, the core PCE price index. What did you think of the way the inflation number came in?
Again, I don't think it was really anything to write home about. It was a non-event. There really was no economic numbers that were driving the markets over the last couple of weeks.
Yeah, it really was some comments from Waller and other things, but really wasn't any of these headlines that were market movers. So let's talk about the top three things to watch up the coming 2 weeks. And obviously on Friday, we have the OPEX, and this is a quad witching. We already seen some of the futures contracts rollovers from the March to June, but it's the typical quad witching quarterly, which tends to be a big one. You think it's going to be a lot of gamma pinning going into Friday?
Well, what I find interesting, Patrick, is that we're above a lot of the strikes that the market makers are long, like the QYLD strike, the JP Morgan option whale strike. So theoretically, you would think that the market would be well supplied with volatility. And yet, even with that, we've had some upticks in volatility. It's been fairly persistent. So I worry about, on the other side of this, when they're not as well supplied on volatility, what'll happen to it. So I think it's a big one to watch.
All right. Well, so number two was the FOMC meeting. I was originally going to put this in number one. We'll talk about number one in a moment. But obviously, Waller put it out a little, well, at least the market tried to interpret what Waller said. And then obviously Powell was just testifying in front of the Senate. So a lot of eyes turning toward the FOMC meeting coming up in 2 weeks. Are you looking for anything to come from that meeting?
Well, no, I think number one is going to be more important, and it'll dictate the number two, which is the FOMC. One of the things I'd like to stress is that the Federal Reserve has told you that they want to cut rates, but they're waiting for the inflation data to be good enough for them to be able to do that. And for anyone that was expecting a change in that, you're ahead of it. So we need the inflation numbers to be good enough so that they can get to that. But until then, we're kind of on hold.
Right.
Which is then number one.
Which is the inflation numbers and CPI and PPI coming out next week. So it's going to be very interesting to see whether the market, obviously the reacceleration of inflation has been a predominant theme in the last month. Do you think that continues?
I think that this inflation number is really, really important, much more so than the unemployment numbers. And I've been saying this for a while, that the unemployment numbers or the PMIs, they can't stop the Fed from wanting to cut, meaning that like a strong employment or a strong PMI, that's not going to be enough to push them off. But yet, if we get a strong inflation number, then that whole 3 cuts that the market is expecting for the next year, that could be withdrawn in a heartbeat. That's really, really important. I think that people are underestimating the kind of negative shock that would occur if inflation ended up being higher than everyone expected. So let me just pull up. I'm going to have a look here, Patrick, about what the market's expecting for this. So this is the February number, right? We're doing it. It's in March, but it's the February number. And I'm looking at my Bloomberg to pulling it up. They're expecting a 318 print, I believe. Is that correct? Does that sound about right?
Yeah.
But if you look at like the 1 year, let me just see here, CPI, the Bloomberg forecast is showing a 3.1, yet the actual inflation swap is showing 318. Yeah, so it's about that. But if you look at like a 1 year swap on inflation, a couple months ago, let me pull it up here. A couple months ago, at the end of January, it was trading at 2. Meaning that for the next year, they expected the market to, average 2%. Well, that 1 year inflation swap has risen to 250. And it was actually 262 yesterday.
Yeah.
And this is a problem. And if we do start to get some inflation numbers that are higher than the market expects, then we could see the Federal Reserve changing the narrative. And let's just remember, they want to cut, but they won't be able to if inflation
It's
perks
stubborn.
back up.
Yeah. Like
Yeah.
if
And I think that's important. And like, listen, just like, why don't you pull up gasoline? Because I think gasoline's a story that not a lot of people are paying attention to, but it's ultimately what drives a lot of inflation, and it's up. Like at the end of January, at the end of 2024, it was 220.
Yeah.
We're looking at 260 right now.
Yep.
That feeds into everything. In
Well,
terms of inflation.
gasoline does, the fact that oil's uptick, but you know, while they're upticked, it's nowhere near the type of surges that really cause meaningful spikes in inflation. Like, I mean, if we were at $3 a gallon, or if we were at $95 oil, then yeah, I would suddenly have a lot more suspicion that that number is going to come in hot. But
yeah, I'm not going to disagree with you there, Patrick. But what I'm going to say is the market is expecting them to be able to cut 3 times this year.
Yeah.
If inflation doesn't behave as they expect and keep coming lower and lower and lower, and the surprises are on the upside versus expectations, then it will be more difficult for them to cut. Doesn't mean they're going to raise. Like I think I've been arguing this for a while, that the unchanged on the year in terms of guessing what's going to happen to Fed funds is woefully underappreciated. Like I think there's a good chance that just nothing happens. They don't raise, they don't lower. It's just we sit here for a while.
Well, interesting. Now, I don't know how much weight you put towards the probabilities that are published by the CME group on the Fed Watch tool, but they still have like a better than a 50% chance that the Fed is cutting in June. And that's coming up pretty freaking fast. And so like if inflation doesn't let up, it's not, like they're not raising in June.
Cutting in June.
Yeah, so cutting in June.
No, you're absolutely correct. And that's my point why I think that the inflation number is the most important number to watch over the next couple of weeks, because it has the potential to disappoint. Now, listen, it might not. It might come in, like under what everyone's expecting, and then the Fed's on track to cut in June. And listen, if we got a really weak inflation number, they might even go in May.
Yeah.
But I think that the inflation number, as opposed to like the unemployment number, which I don't think could have affected policy except for a complete kind of crash with lots of people losing their jobs, which isn't going to happen. But like my point is, a strong inflation number wouldn't stop them from cutting in May or June, but a strong inflation number does.
Well,
I might have said that wrong. A strong unemployment number, meaning lots of employment, doesn't stop them from cutting in May and June, but a strong inflation number does.
Yeah. So what's interesting, if you look at the 10-year yield, is the 10-year yield really shaved off, it shaved off from 430 down to 410 over the last 2 weeks. It's clearly not making the long bonds nervous here, where like and you think that this inflation number could spur some volatility here in bonds for sure, right?
I would agree. I'm actually surprised at how well bonds are behaving.
Yeah. They're behaving rather bullish, to be honest. All these dips are being bought, holding in. One of my themes has been that the last year's October low was going to be the multi-year low in bonds, even though maybe not the decade low. There could always be another surge later in this decade where we're going to have another leg down in bonds. But I don't think that we're going to see north of 5%. At least this year is my theory, but obviously you puke in your mouth a little bit when you hear that. Well,
I was wondering what will you give me for a one touch? I feel like we should get the betting back, and because I would love to take the other side of that if you price the one touch at an attractive level.
You know what? Let's work it out off the show, and maybe next episode we'll come in and we'll make a bet.
Okay, sounds good.
All right. So Let's talk the markets. First thing, let's talk about just how hot this S&P has been. By the way, I'm looking at the continuous chart. Today was the rollover of the March to June contract, which was over a 50 S&P point jump between the roll. That is not a gap higher, and so no technician should be getting excited about a gap that on a continuous chart that was simply like, actually the best is to look at the cash index here to kind of reflect on what really happened. And it was interesting because we printed almost up to 5,200 on the cash index, and it's fading a little bit off of its high, but overall it's been a predominant bull trend, and it's been sustained from the January 1st. Like literally, we are now going on 2+ full months of sustained trend, higher highs, higher lows in a clear channel. And at some point, a market correction is going to ensue, but there's just so much that's been driving flows into this. But it's amazing. It's at this moment, I still don't see much upside in the market. Maybe we print over 5,200 temporarily. At some point, though, there's going to be one of those typical 5 to 10% market corrections, which is going to be in the 300 to 500 S&P point type variety. So there's no asymmetry in putting on new long positioning here, but the trend is still in favor of the bulls.
You know, what's interesting today, we're taping this at 2:00, and so who knows where the market's going to close, but we had a big kind of emotional reversal.
Yeah.
And this morning when we got up, there was, you mentioned 5,200, and that's what kind of triggered me to remember this. There was like 30,000 of the 0 DTE, like today's 5,200 calls that traded. 30,000, like $15 billion of notional was bought this morning in this kind of just emotional, like, just get it in. I'm worried about the market exploding higher. And that's drove the market up in the morning. Then all of a sudden we got this big selling. There was somebody that sold, like, I can't remember what the number is, like a $700 million of NVIDIA within an hour. Came in and did that. It has the kind of a feel of one of those days that we might look back and go, you know, something changed today in terms of the kind of the emotional and the tone of the markets.
Well, it's funny because yesterday when I was doing my typical webinar for my big picture trading members, the one thing I said is that NVIDIA is really one of the last man standing in terms of the Mag 7s. I mean, obviously Meta's been holding up, but the other ones have all broken. And I said the day that we see the blow off top on NVIDIA will mark the high of the S&P. And
there you go.
So I said NVIDIA is the single most important stock to watch. And here we are today with it printed within a stone throw of 1,000, which is insane in the first place. I mean, we were literally a month ago at under $700 on the stock. And so this thing ripping, 200 plus, almost $300 in such a short window of time is just amazing how much market capitalization it contributed. But what is crazy, it was really the only stock. Like, well, let's just go through these. Like Apple, a little bit of a bounce today, but I mean, the thing has been just awful from $200 down to 170. It's been selling all year. You look at.
I think, Patrick, it's the fact that it's up today is because NVIDIA is down. I think Apple has been a source of funds. People have been selling it, shorting it, whatever it be, to buy the other ones. And so when we had this switch in terms of NVIDIA with the selling,
so you're saying
I think you actually had, I think the market is increasingly becoming like that, where you get these stocks that become negatively correlated in just the strangest, weirdest fashion. You'd think they're both tech stocks, they should move together, but no, because they're traded one against another, it actually ends up being that you could have a day where all the tech stocks are getting crushed and Apple is bid. And the reason Apple's bid is because Apple has been offered for the past month, as you pointed out.
Absolutely. But, it's interesting. Google got a little bit of a pop as well, but it's been also very heavily distributed. And then, like, when you saw just the other day, Microsoft had a big red reversal candle earlier this week, kind of making it look incredibly toppy. And so you really have the Mag 7 really down to Mag 2 because Meta is the only stock I would argue that has been, working its way higher with NVIDIA, nowhere near the momentum of NVIDIA, but at least it's been making higher highs along the way. Even Amazon, while it's been a relatively bullish chart, is kind of run out of momentum. It hasn't done anything bearish, but it certainly hasn't been contributing to driving the index higher. And so we have a scenario where, we haven't seen really energy stocks get any love. You haven't seen too many sectors really getting too much flow. And then you have the Mag 7s getting thinner and thinner in terms of which ones are driving the market. And this is why I think NVIDIA was such a critical stock to watch, because it literally was the bubble stock. Like, it was the one stock that defined this entire advance. And so it will be really interesting to see whether today, whether that bearish engulfing candle in NVIDIA ends up being something more meaningful. And I'm not ready to rush to a conclusion, because one of my most important lines I always say to my members: one day does not make a new trend. And so just because we saw this one day reversal is not enough to already say that that was it. But if we don't see the bulls recover in NVIDIA in the first few trading days of next week, that could be a top. And so I think by the middle of next week, we'll have a pretty good idea of where we stand on that. Any last comment, or we move on?
No, let's go on to the next
Let's
thing.
talk gold. Like,
oh God, don't gooch it,
I'm
man.
not
We
going
should
to
just
gooch
keep our
nothing.
mouth
I'm
shut.
just saying, like, we have not seen gold behave this way in a very long time. I mean, okay, off the October low, which was a very oversold state, it did have, a sustained, 2-3 week advance that was a similar $200 advance off of some very oversold conditions. But this has been a relentless rally where there isn't even intraday pullbacks. Like almost immediately, even a downtick of a few dollars brings in buyers almost instantaneously. Now, I still, every rally gets checked, and there will be at some point a $50 pause, just because that's what markets do. But the one thing that I'm going to be watching is whether a $50 pullback immediately gets bought on dip. Because if it is, then this thing's going to 2,300. There's all sorts of weekly and daily chart measured moves that are measuring the 2,300, and it's a very, very realistic goal for this impulse. And if gold is sustainably trading in the kind of 2,100 to 2,300 area for a sustained period of time, it means that a new bull trend is underway, and that might keep it bullish all year long. So watching the way traders behave on the dip is going to be pretty important for me to how sustainable this bull trend really will be.
I'm scared to say anything, and I won't comment about my own personal belief to hopefully not gooch or anything, because you were awfully bullish there. But I will note that our buddy Ronald Sterfely from Incrementum, that he does the In Gold Trust, In Gold, is it In Gold We Trust or whatever?
Exactly.
Great report for those gold bulls. He says that usually when gold runs, he gets all sorts of phone calls asking to be on, like comments and stuff. And this time, gold's hitting an all-time high,
and no one's calling.
Nobody is calling him. So
that's ridiculously bullish.
I tend to agree with you. Like some people get scared and go, you know what? And the other thing that people are having trouble with is the fact that they can't explain why it's going up.
True.
And so can I read you a quote though from Bruce Kovner, who I think is one of the most underrated, awesome guys out there? The Heisenberg principle in physics provides an analogy for the markets. If something is closely observed, the odds are it is going to be altered in the process. If corn is in a tight consolidation and then breaks out the day the Wall Street Journal carries a story about a potential shortage of corn, the odds of the price move being sustained are much smaller. If everyone believes there is no reason for corn to break out, and it suddenly does, the chances that there is an important underlying cause are much greater.
Really?
And I love
that. It's so smart.
I'll leave you to substitute corn for whatever you want in there. But the fact that people can't explain why it's rallying doesn't bother me at all.
Love it. The interesting part, though, is that these gold miners, like, I mean, when you really step back and put even, I'm going to put a monthly chart on gold miners and recognizing that gold is at an all-time high. These gold miners, even like you have to, and this is not even inflation adjusted numbers. The gold miners are at ranges they traded in 2009. You know, like this is a sector that has been left behind. No one wants to touch it with a 10-foot pole. And to be honest, the charts are still relatively bearish. Even though we had a very strong week, we haven't been able to beat the January level. Or even the December levels. So we have a scenario where the gold miners really haven't even started to participate. If this is a legit breakout and people start to notice, then the gold miners, a lot of people get worried that they're chasing something because, the bus has left the station and they're not on the bus and they're just chasing. But really, you're buying at price levels that you could have bought in the last 6 months. This is not like this thing is running away from you.
I don't know if that's a good thing or not, Patrick. Like you pull up today, gold's rallying, Barrick's unchanged, Newmont's flat. As that great trader Gordon Gekko once said, he said, Jesus, if this guy owned a funeral parlor, no one would die. That's exactly what we got going on here. Like but you know what? Here's the thing, Kev. Where I'll disagree with you. Okay, I get the point that you're making, and I don't want to disagree in that sense. I just think that this, to me, is just showing evidence that we don't even have evidence that the first inning of the game has started because nobody even is giving any attention. Like ultimately, the markets are all about flows, and the thing is that stocks or sectors need a certain amount of attention in order to get the flow. And the fact is that your theory of like if you own a funeral parlor, would anyone die, or is it simply that this is not on anyone's radar? No one gives a shit because money's being made in so many other places that they just haven't. This has not moved its way up on the watch list to take any legit new money. And so I would agree with you, and I'd actually say that the reason that these don't go versus gold is that gold is getting pushed by non-financial actors, meaning that I think it's getting moved by the central banks. And the central banks don't care. They're not going to go buy Barrick or Newmont. So therefore, they're just buying the physical. And so if you look at it, most financial guys are actually bearish gold. But I actually find the amount of people that are skeptical, they're telling me, I'm going to sell it. Like it's shocking. So to me, that's why, one second, but to me, that's part of the reason that the gold miners suck so bad.
Yeah.
Is because there's two different types of people playing in the two different squares, and what's driving the gold square is different. It's central banks as opposed to financial actors.
Right. So Newmont, as an example, went from $80 to under $30, right? Just a devastating bear decline in just over a year and a half. The thing wiped out 65% of its value, essentially, in just under 2 years. And it's been an awfully distributed stock. Now, sure, they had management problems, execution problems, all sorts of stuff that you can argue justified it. But ultimately, if gold is trading 10, 20% higher, suddenly all of their bad management mistakes suddenly are fixed by the fact that the underlying from which their profit is made has increased, allowing their margins to improve. Like at some point, analysts are going to suddenly have to say, well, shit, their balance sheet isn't looking that bad anymore. Right.
Well, it could be. And listen, I hope you're right. So like I'm long like the GDXJ and stuff. So it's not like I want these things to happen. I'm just saying that their performance, given the gold move, is awfully disappointing.
Yeah.
And it worries me because instead of just saying, oh, the market will eventually figure it out. What if it doesn't? What if it's telling you something? Okay. What if it's saying that these stocks stink and they're not going to make any money?
I know the implieds are different and therefore moves are different, but gold is up 10%, right? $200, 10% in a span of 23 days from its trough to peak move, right? To say that gold miners haven't participated from trough to peak, the gold miners are up 16 or 17% in 9 days.
I hear you.
Okay,
You got a point there, but Patrick, gold is on all-time highs.
No,
look
but
at
this
GDX.
is the whole point. What you're doing is you're judging the start point because they were so underperforming gold up until this point. But to argue that
that's a good point.
that they have not participated on a percentage basis, they've outperformed gold in the span of that 23 days. And so anyway,
that's a good point. I can see that. You're absolutely correct. I'm getting upset about previous suckage of the gold index.
Yeah.
And the reality is that if we just kind of look at this last little bit, you're absolutely right. So I take it back. So I will stop complaining.
So let's talk about nat gas. Now, it was so ridiculously over. So I should forget. I want to go first of all. Let's just do the big boy crude oil. Crude oil has been relatively positive price action for 3 months in a row. Generally higher highs, higher lows, dips being bought above its 50-day moving average. All the kind of things you want to see that a bottom is in, but obviously, the lack of follow through or gaining momentum is the disappointing part. And the thing about crude oil here, I want to see that the mid 70s hold all pullbacks. Like, can this still drop from 78 to 76? Yes. But I want to see the pattern that dips are being bought and traded right back to the top of the range for me to keep this at the top of my watch list. If we see that this becomes far more of a ping pong match in a trade range, then I might be lightening up on my crude oil positions. And so to me, what it does here on a further dip is going to be critical. I personally am going to buy a dip down to 76. That's what I always do. I buy dips. That's like the way that my trading philosophy works. But it's going to be critical that those dips get bought and hold. Otherwise, that's going to tell me that this is going to be far more of a boring story than a new bull trend. But I'm still going to give the bulls the benefit of the doubt here.
All right. You want to talk about nat gas too?
I do. And then we got to go back to currencies. I forgot we didn't talk about the yen yet because I wanted to just, I'll touch on that, but let's quickly touch on nat gas. So what I wanted to highlight was that it was so ridiculously oversold that anything has a reflexive snapback rally. But even if you measure this rally relative to what happened in December, the incredibly oversold condition back then warranted almost a 28% 60 cent snapback rally, which is a typical kind of reflexive bounce from an incredibly oversold state. Here, we basically had a scenario where this bounce went about 25% or 40 cents, a much weaker bounce without even the same velocity before it started to roll over. It's just too early to be calling a bottom on nat gas. Now, often when you get this cheap, then it probably isn't going much lower than its low. But I would, at this stage, suspect that the remainder of March and even a chunk of April will be a lot of natural gas establishing its trading bottoms than it is about setting up for a bull breakout. I think that this is going to be much more of a meat grinder down here for a little bit. At some point when nat gas is this cheap, there's going to be a trade to the upside, but I suspect the trade is going to be a little bit farther down the road, and I wouldn't be too ambitious about this happening immediately.
I like that. A meat grinder. You heard it here first.
No, that's not an original thing. But anyway, okay. Those that never heard it, you heard it here first. There you go.
I heard it here first. Let's put it that way.
All right. The interesting thing, copper popped. Now, I've been talking about a big trade range in copper between $3.50 to $4, and I really don't see a reason why copper should break out of that trade range till we're on the other side of an expansion cycle in the global economy. And eventually there will be an expansion cycle. Maybe it's even a year away or a half a year away. But I really still think that copper has a lot of overhead resistance here, and very similar. It's as good of a risk to come back down into the mid $3 ranges and grind mind as well. And I wouldn't be too ambitious about this bull trending immediately in the first quarter of the year.
I got nothing to add, Patrick.
All right, so let's move on. Just touch on uranium. An uptick yesterday in that U308. Obviously, we were trading at a 15% discount, and I'm sure many listeners heard it here first when Kevin highlighted that this thing could trade even a 20+% discount to net asset value for prolonged periods of time. But we are trading at a minus 15%, which is not far from even your really worst case scenarios on that. I mean, at what point do you dabble in this one, Kev?
I'm not touching this for a bit.
Really?
Yeah.
Okay.
I just like I know everyone loves it and stuff, and like I almost would rather go buy the stocks if we got a dip.
No
and
problem.
I know that's like completely against what everybody thinks, and I'm going against my buddy Cuppy, and so, but like. And I know they all hate Cameco. They think it's shit and stuff like that. But like if I had to do anything, I would try to buy like a dip. Like if we got a 35 on Cameco in the States, like that's where I'd like to buy it.
So what to me, what I want to share here is that I believe that there is definitely forms of symmetry, and in one way, a 6-month plus rally. It was arguably even a 9-month rally in uranium that was a pretty sustained uptrend, usually has a market correction that has some proportionality, which is that usually you don't have just a 2-week or 1-month correction in a 9-month run. Usually you'll have something that's even 1/3 of the length. So after a 6-month run, expecting a 2-month market correction is a very typical from a time frame perspective. And so the fact that we're just over a month into this, if we see a rally fail below $30, I could send it right back down to $25, and this thing just continues to kind of spend some time backfilling this huge rally. I still am actually super bullish uranium. It's just about having a realistic expectation when the next kind of bull run could begin. It would certainly happen this year, but the remainder of the first quarter could end up just being a further profit-taking cycle, grind this down a little bit. But I still think down here in this $25 to $27 area, this is a very, very interesting price level. It's just, even if you bought there, how long would you have to wait for it to turn back up? That's my thoughts. Kev, let's talk quickly the US dollar yen, because you have to do yourself, you've been under so much pain in this trade the whole year. And 3 days saves your day.
No, it wasn't pain. It was testing my resolve. It was wanting to make sure that I really believed in it. Nothing good comes without like a little waiting and a little pain.
A little waiting and pain. There you go.
Yeah.
And how was the pain? Was it worth it? Does it feel was it worth it? Anyway, but obviously a pretty significant throwback. We basically wiped out a month of US dollar advances in 3 days. And we're now actually coming into a pretty critical level along that Jan-Feb low, which was around this 146 level. But this is actually going to be a very key tell, because obviously we've had a sustained run, and a quick correction like this, if the US dollar bulls are in control, we should within next week see some sort of reflex rally back north of 149 to really kind of end the idea that there's this major yen rally underway. It would be, in my opinion, any failed bounces here that keeps it well below 149 on bounces that you're going to continue to have a smile on your face. But the fact that we had this 3-day drop of this magnitude, I think that the bulls really have to come, US dollar bulls anyway, have to come back and not only hold the line, but they have to create a reflexive pushback that gets this back above 149 quickly. You know what? I don't know if I have too strong a conclusion. I'm generally bullish the US dollar.
No.
Yeah.
Come on.
Yeah.
Really?
Yeah,
That's
but
very
I wanna,
unedual. I never expected
you
that
never
from you.
expected it. I never.
No.
But I will tell you something, Kev. I am not a milkshake man here. Even
No, for sure. You
but
will, when it goes the other way, you will go. You know, you have a tendency to go one way, and you will see things a little more quickly one way, but you won't fight it, and you will actually hop on board if it's going.
I do believe inevitably when we are in an expansion cycle and an easing cycle, the U.S. dollar will be in a bear market. And it will be of a more than 1 year kind of sustained downtrend, which will be incredibly bullish for commodities and all sorts of different things. It's just the real puzzle piece is when the hell does that start? And I think that obviously can be pushed not only the second half of the year, but it might even be a 2025 story. But so right now, I'm only thematically saying that the U.S. dollar could stay in its bull trend, for the most short to intermediate period. But there will inevitably be a U.S. dollar bear market. I think with your yen trade, I'll say it over and over again. I think you're just always a couple years too early. I think that that's going to be a really big payoff trade that will work very, very well. It's just when is the actual major new trend actually begin? And you might be waiting a little bit. I still think
could be. I can't figure it out. And you know what? I've never found anyone that reliably can tell me, oh no, this is the trend in biblical time at all. But if you can, you let me know.
That's because you don't listen to any of the macro outlooks I do, right? That's it's just the way it works, but it's okay. You know what? I wanted to look at the reverse treasury bond. Just look at the 10-year bond as opposed to yield that we did. And this still looks like it wants to go higher. It'll be so interesting to see whether the FOMC or the inflation numbers kind of change the trend. But right now, this feels like it wants to make another stab at those December and January highs along the upside. Was there any other charts we were supposed to cover? Is there anything else you want to touch?
Well, no, but you know what? Actually, we don't have No Stupid Questions. And in my chat, our buddy Jonathan is asking for Patrick's opinion on a chart. And I thought maybe, you know what? Let's ask Patrick what he thinks.
Do it.
It's ARM Holdings.
What's the symbol?
And ARM. Oh, yeah. There we go. So at least you're not going to be influenced by what the company does.
Well, this says semiconductor.
Jonathan wants to know if this qualifies as a rising wedge pattern.
No.
Well, I think he's going to be happy about that because Jonathan's in a short. So
when a stock gaps this way and then gets bought on dip on the first thing, you have to respect that the bulls are in control, and to already be betting that the transition moment to bears beginning the deep mean reversion back down is already underway. It is a risky bet because the trend is not your friend here. And but what will help this case is if Nvidia peaked, because I think if Nvidia peaked. And that's still something that will take a few trading sessions to know if that's the case. But if it has, then all of the air might be let out of the semiconductor momentum, and that could be enough to get this have a solid breakdown candle.
You say the trend is not your friend. I would agree with you there, but I would tell you what is your friend is the IPO lockup that is coming due.
And when is that?
And this thing has just got tons of stock, and so. This is a made-up price for a tiny portion of the company.
Right. Okay. There you go.
So I know we're mixing fundamentals with there, and
No. But you know what? That is but flows are in the end. Technicians are all about flows, and that an IPO lockup will influence flows. And I mean, even though it's not technically on the chart, it is the spirit of technical analysis, which is that there will be selling. Right. And that will change the trend, right?
There will be selling. That's like there will be blood.
There will be blood. There will be blood. There always is on everything. In every stock ultimately mean reverts, even those people that are so convinced NVIDIA will never go down. Let's see.
We should put that on YouTube. So every stock mean reverts.
It's so true. I do believe it. All right, bud. That's enough for today. Let's move on to Crayons with Kev.
Crayons with Kev. Speaking of my chat group, they insisted, well, they didn't really, but they suggested that when I put a chart up there and put a squiggly line on it, they were like, you got to use this for Crayons with Kev. And I was like, you know what? I think I will. So what you're looking at there, Patrick, is the MSCI World Automobile Index.
Okay.
And I am bearish for fundamental reasons, and I am doubly bearish for technical reasons. And I think that this is just those highs keep being lower and lower and lower. It's hitting the trend line almost bang on to the penny, as Carter Worth would say. And I think this thing's headed to 150.
Fair enough. What I like about consolidations, like what you're seeing throughout the last 6 to 9 months, is that it's actually much easier to manage risk. That ascending trend line up above there, including a number of those previous highs, clearly indicate to you when you've been wrong, right? And so I look at things from an asymmetric perspective. Can you manage the risk down to a small component where the the downside potential is greater than the risk you're undertaking? And the fact that throughout such a bullish period in the markets, this thing could not sustain rallies, and you can put your stops so tight. It is certainly a trade that's worth dabbling with, but obviously confirmation will come on a break of 250, right, where all those lows were, because once it's below 250, then it going back towards 150, or at least the 2022 low, would be a very realistic target.
Got it. All right.
There you go. You heard it here. And we have, I know there was a couple of no stupid questions, but I'm a little bit under the weather.
Yeah,
so we decided we'll go through them all next episode. Anyway, so let's wrap it up, Kev.
So thanks for tuning into the Market Huddle. We appreciate you spending some time with us. Patrick, where can they find you?
You can find me at bigpicturetrading.com or follow me on Twitter at Patrick Cervantes. And Kev, where can they follow you, buddy?
They can go to Substack and they can check me out at themacrotourist.com/chat. I think it works, or I hope it works. But somewhere in there's a link to the chat, and come by and say hello. Everyone can come. You don't need to be a subscriber. Welcome to anybody that's interested in the markets. Patrick, listen, we can never have too many friends. Bear market, bull market. We're just happy to spend some time together on this crazy ride. Now stick around for the after show.
Absolutely. All right. Well, Daniel, you can hop on here, buddy. I'm going to rate this beer. By the way, I managed to score a couple of British beers, and I got them in twin cans. So when you swing by Lisbon this weekend, I'm going to set you up with some beers that you'll be able to rate with me in the coming episodes.
Ooh.
There we go.
So
that's what we need. We need to replace my sorry ass that barely drinks
with someone who actually knows.
This actually feels like a promotion. I'm not sure how to feel right now.
So let me rate this Steam Brew, this wheat pale ale, and I have to say, if Steam Brew were a person, it would be the life of the party, man. This is fantastic. I love this beer.
Can you tell me whether you can taste or not, or whether that's?
No, it's probably because I'm sick.
That's what I mean.
No, you're saying like you have the vid.
I have no taste. I don't know why this is so good. Anyway, I'm here with no taste in my. No. I really like it. I like it. I don't know. You know what? I'm gonna do it. I'm gonna give it a 9.0.
Oh shit!
Come on! I'm giving
Seriously?
it a 9.
Isn't that the
I'm giving it a 9
highest
handle.
one yet?
It is. You know what? I don't know why. Like, because I know Kev, you're into the India pale ales, right? But this is a wheat pale ale, and it is so easy to drink. Tastes great. I actually really like it. Yeah, I'm gonna go and I'm gonna go grab a couple of these and bring them back to Lisbon with me. I'm down here in the Algarve, and I haven't seen these up in Lisbon. I'm gonna bring some back. This is great beer.
So you guys are both in Portugal and the weather sucks? That's what you guys were telling me?
Yeah, to be honest, I wasn't sure whether the internet was going to drop out, because sometimes when the weather's bad, all the electricity cuts out. So I'm praying that we keep going.
Elon Musk.
Well, yeah.
Like you're not on the Elon Musk
No,
anymore?
I'm on Starlink. Yeah, 100%.
Well, I think what you have to be more worried about is that he checks out my Twitter feed and then figures out that you're attached to me.
I'm going to get the helicopters come overhead.
There you go.
Now, the thing is, for a Brit to be complaining about the weather, it must be pretty shit. And then for a Canadian to be complaining about the weather, we know he's gotten soft.
Well, yeah, I'm sick, and but that came from last weekend in Madrid, where frickin' there was a hailstorm, snowstorm in the middle of the weekend.
That's like Tuesday for us.
No shit. But the thing is, here I went in my summer clothes. I brought shorts and flip flops. No, no, I didn't. But still, it was I got sick. It's my own fault. I'm an idiot.
It was probably too much drinking and hanging out with all the Spaniards. No, it could never be too much drinking. Oh, Patrick, I have something that's going to make your blood boil.
Oh, tell me.
There's on Bloomberg these days, there's commercials. Usually they're kind of things geared towards me, like hair loss stuff and lose weight and shit, old man stuff. But now this one is you know how you can have a Keurig that makes you a barista, it's a barista. Yeah. There's now one to mix for mixed drinks.
Mixed drinks cocktail. I saw that. Yeah, I've already seen it.
So for those who don't know,
a margarita or something.
Patrick thinks himself quite the bartender.
Well,
this is his hobby.
Yeah.
No, I'm sure he is, but he's very into it. We were at dinner at Christmas time or sometime around then, and he's discussing with the bartender and choosing all these things for us. And I was no clue. Just bring me some beer or wine. And Patrick going on and on about all these things. And this, I didn't realize Patrick wants to. But you want to get into some sort of contest, or you wanted to actually get your house registered as a bar, basically. Have I got that right?
Yeah,
you do. Yeah, pretty much. So for those who, you probably need to have some relatives there. So you should just open it up and have market huddle, I'm having it at your house.
Oh yeah, no, definitely. But it's let's be realistic. Cocktails are far more geared toward
alcoholics. No, wait, what? I said the A
towards
word.
Ladies.
Oh, sorry.
It's unfortunately we have mostly old men that listen to the show.
That's not true. A lot of men like cocktails. I don't, but a lot of men do. They've been drinking shit forever. They used to go drink. I remember at the bar because a lot of guys try to they don't want the calories.
What percentage of porn star martinis that are ordered do you think are ordered by men?
Whoa, what is a porn star martini?
It's got the.
I think it's pretty high.
What?
Though, when I used to work in a bar, all the men would want the sweet fruity drinks.
No.
There you go.
No.
Yeah.
100%. No, I don't believe you.
No, honestly, so wait. We gotta go take this. We gotta take this one question at a time. Answer me, what is a porn star martini?
Oh, it's got the passion fruit in it, which makes it not dry at all, which I don't know why it gets to be called a martini, just because it's put in a martini glass. But it's obviously a drink made to be, obviously appealing to someone who doesn't like, bitter drinks. Yeah.
Okay, and then Daniel says that when he was a bartender, did you make all these things? So could you make all these crazy drinks as well?
Oh yeah, no, he mixes
10 years I was in. Yeah.
Wow. So now, Daniel, if someone says I want a porn star martini, do you know how to make that? Do you have that one memorized?
I do indeed, yeah.
Okay, well, tell me what's in it.
Well, usually, so first of all, I put a pink top on and then put a thong on, and then I mix a bit of passion fruit, vanilla, and maybe get a a sparkly glass out, and then
so obviously vodka based, and then you but the thing is that sometimes they have the passion fruit liqueur. You don't need to have it, but it is for the official one, you're supposed to have passion fruit liqueur. But vodka with the passion fruit juice and lime juice, and then put a little prosecco on it is the typical.
What's paseo?
But prosecco is just
I know what prosecco is, but what's paseo?
Oh, Passoa.
Passoa, sorry.
That's the passion fruit liqueur.
Oh, that's the passion. Wow, you guys actually did know this. That is wild. You guys
Now,
crack
by
me
the
up.
way, I have to say, I actually never drank one before. I've made one
yeah.
before. but
So you say
You want one this weekend?
Yeah.
No, I'm not. There's certain rules I have about cocktails, and drinking a porn star martini is one of the banned drinks in my.
Okay, well, I'll tell you what. When I come to Lisbon to the, what do you guys call it? The Rum Shack?
Yeah.
You're going to make me one of these. I
Absolutely.
am confident enough in my sexuality that I don't mind
Brilliant.
drinking a
Brilliant.
porn star martini.
Porn star and a beer.
There
That's
you go.
right.
That sounds great. Sounds like a great night in.
That's hilarious.
Okay, well, let's let Patrick go because he's sounding like shit.
Yeah, I know,
thank
man.
you
I'm
for
so
everyone
sick.
thanks for tuning in, everyone. We'll see you in a couple of weeks.
All right, take care, everyone.
Bye-bye.